Okay, in this video, we're going to go through some of the ratio computations. So we have the company's balance sheet for 2 years, and then we have some additional information that we may need when we're trying to prepare these ratios. So the first ratio is the current ratio, and it says to prepare it as of December 31st, 2022. So for us to do that, we just take the ending balance of the current. Our formula is our current ratio equals our current assets divided by our current liabilities. And then make that bigger. Okay, so that's our formula. So then now again, we're trying to solve for that. So our current ratio, or I'm sorry, our current assets are, this is not a classified balance sheet, so it's not breaking it out per category like that. So we have to do a little bit of work. So we go back to the balance sheet and we say, okay, cash is a current asset, that's 15,000. Accounts receivable is a current asset, that's 70,000. And inventory is a current asset, and that's 60,000. So we have $145,000 of current assets, and then we will divide that by our current liabilities. And it does tell us that the bonds payable are due in 2035. So those are way long term. So the only current liability that they have is the $50,000 of accounts payable. Okay, so then now we can just solve that. So if we take 145,000 divided by 50,000, that gives us 2.9 as our current ratio. Okay, then we'll come in, and our next one that they want us to solve for is our accounts receivable turnover. So if you look up your formula for the accounts receivable turnover, the formula is our sales, our net sales. It does say net sales on account, but that's what they give us, so we're good. So our net sales divided by our average accounts receivable. So when it says, when it says average, then we got to do a little bit of work to figure out that average. So we're going to compare So we know our sales. So our sales are provided here. Sales on account were $375,000. Sales returns and allowances amounted to $25,000. So again, and I should go back up here, it says net sales. So when we see the word net sales, we know we have to subtract those sales returns and allowances. So then that would be $350,000 of net sales. $375,000 minus the $25,000. Now our average accounts receivable, we're going to take these two up here, our 70,000 and our 60,000, add those together. So we have 130,000 divided by 2. So we have a $65,000 average between those 2 years. So then our accounts receivable turnover will be 350,000 divided by 65,000. And that gives us 5.38 if we round it to the, we could round it to the nearest tenth. I guess I'm not a big, as long as you go out at least one decimal. And then this is a times. So it's saying that we turn over. So sometimes you'll see that with an X by it. So it's saying that we turn over 5.38 times a year. Then that feeds us into the next one. The next one says, well, what's our average collection period? Well, these are the same computations. So our average collection period is calculated by taking 365 days in a year and dividing it by that accounts receivable turnover. So these do go hand in hand, so we'll do them together. So our average collection period is going to be 365 divided by the 5.38 times. 65 divided by 5.38 gives us 67.84. So again, you would probably leave that to one decimal. It looks like the textbook probably has us do it. So the average collection period would be 67.8 days. So that's not a great statistic. I guess you'd have to go back and say, well, what are their terms? What are they offering? How long are they giving their customers to pay them? Because say their terms are net 30 and the customers, the average collection is 67 days, that's definitely an issue. So we'd want to double check that. Okay, then if we move on then to our inventory turnover, which is our last one. The formula for our inventory turnover ratio is our cost of goods sold divided by average inventory. So again, we see the average inventory, so we know we have to do a little work to figure that out. And then let's see, and then here it tells us cost of goods sold. So our cost of goods sold are $198,000, so we can fill that in. But then when we come to our average inventory, we have to go back to our balance sheet. So in 2022, it was 60,000. 2021 is 50,000. So add those together and then divide by 2 to get to an average. So again, it's just a basic average. So that's $55,000 is our average inventory. So then now our inventory turnover is 198,000 divided by 55,000. That gives us 3.6. Now it doesn't ask us to do this, but it goes hand in hand, just like so this one too would be a time. It's saying, okay, I turn my inventory over 3.6 times. It feeds into the days in inventory. So I'll go ahead and do it since we're halfway there. So our days in inventory is our 365 days divided by our inventory turnover. So much like we just did in the one above with our accounts receivable. So 365 divided by 3.6 gives us 101.3888. So we'll round that to 4, 101.4 days. So again, when you're looking at that, you're thinking, well, you almost have to compare it to the industry average to see if it seems reasonable. But say they're a dairy producer, obviously that would be horrible. 101 days in inventory would be very, very bad. Maybe they're a car manufacturer, and then that isn't so bad. So again, you'd go back to determine what their their industry average is to judge if these are good or bad.